Okay, well, Peter Cardillo is joining us now. He's Chief Market Economist at Spartan Capital Securities. Peter, good morning. Good to have you with us here on the program. There is some disbelief I can sense from many sort of Fed watchers and macro watchers, etc., saying, well, is the Fed really saying that there is no recession all the way till 2026 or 27? It's going to be higher for longer. Is that the way to read the policy and the statement of the Q&A from last night?
No, I don't think so. In fact, I think Fed Powell was quite clear, especially during the conference, during the press conference, that he said, the risk can be either way. He did reiterate that the path to a soft landing remains, but he also said that under tightening and over tightening could be a problem. So the fact that they're poised to raise rates one more time, and then, of course, it's data dependent, that, suggests that somewhere along the line, we're going to have a consumer recession. The high cost of financing credit, especially credit cards, is weighing on the consumer. And you could see that. I mean, we've had some fairly stable and good retail sales numbers. But as we get closer to the holiday season, most of the indications are that the consumer is not going to spend as heavily as they did in the previous years. And that's because, the American consumer spends on credit cards. And so they are spending their way. And this is a problem when you have high interest rates. And then, of course, the other problem that we have is high oil prices. Gasoline prices here in the States have gone up, and they're not really that far away from their high point of the beginning of the Ukraine-Russian conflict. And so that's another factor. The American consumer is likely to think not once, but maybe several times before he spends on items that are not necessary. In other words, the consumer is getting strapped by the high rates. And so I think the Fed is wishful thinking that a recession cannot happen in 2024. I admit that I was wrong. I admit that I was wrong.
Peter? Sure. Sorry, we are actually running a bit short of time, so I wanted to squeeze in a couple of more questions. For the viewer watching you right now, largely the Indian viewer, the only question on his mind is, if rates are going to be higher for longer, does that mean like risky assets like equities take a back seat for the rest of the calendar year? Is that your view?
No, not necessarily, because I think, if you look at the yield curve has been doing what it has been doing, and the stock market continued to rally. So I think the next catalyst, there are two next big catalysts, and that is the inflation data and, of course, Q3 earnings. And if Q3 earnings come in slightly lower than the previous readings, I think the market will probably rally. Now, are we looking at an explosive rally? That's questionable. Are we looking at a strong sell-off? That I don't think, because a lot of what the market was expecting from the Feds came to fruition.
Hi, Peter. Good morning. Peter, from an India perspective, we also track two big indicators. One is Brent crude prices, which have surprised everyone, moving to $90 per barrel plus. We don't like that too much. And the dollar index as well has strengthened. Where do you see both those two asset classes headed?
Yeah, I remain short-term bullish on the dollar. I think the dollar index is headed to around 96.25. And as far as oil is concerned, from a fundamental viewpoint, the price is rather high and rich at this point. Technically, the market remains strong, although over the past several days we did have a battle between the bulls and the bears. When I say that, I mean there was resistance around that 92.5, 93 level, and the market failed at least 3 times, breaching to the upside. So that suggests that while the technical outlook remains strong, probably we're not going to see oil prices move to the high 90 area until we clear this resistance level.
All right, Peter, we'll leave it there. Thank you very much for your time. It's a pleasure having you with us here on the program. Thanks indeed for your perspective on the Fed and, of course, where markets, etc., stand. We'll take a quick